Good morning, everyone. We've just hit 10 a.m, so we're going to start this investor call with Wesley Coote, CEO of Healthia. So firstly, hello, welcome to everyone. Terrific to see we've got quite a lot of people online. We've actually got a few people from overseas, which is nice to see. My name is Alfred Chan. I'm from Principal IR, and I'm just going to help Wes run the session today. Just a quick run through of formalities. After the presentation, Wes is going to be taking questions from attendees. If you do have any questions for Wes throughout the presentation, there's a sidebar on your left-hand side of the screen if you're on a computer. It's down the bottom if you're on a smart device. Just hit the Q&A button, and it'll open a chat box where you can enter questions that we'll present to Wes after his presentation. We've had quite a lot of new investors come onto the Healthia register over the past 6 months. So if anyone not familiar with Wes, he and Chairman Glenn Richards previously linked up at Greencross, which they oversaw to become the largest vet and pet supplies business in Australia. So when it comes to nationwide consolidation companies, the Healthia team have an outstanding track record. Since listing in 2018 on the ASX, Wes has led the Healthia business to grow extensively across clinic numbers, revenue, profit, and headcount. So look, most of you might have seen a summary of the results already. So Wes has been very generous with his time to shareholders. So I will hand over control to Wes.
Excellent. Thanks, Alfred. Good morning, fellow shareholders, Healthia team members who are online, ladies and gentlemen. I'll just share my screen with you now. We have just put up the results in an investor presentation. I won't go through every slide of the investor presentation. I'll just call out the important ones I think it's important to talk to today. You know, I'm pleased to be able to have this call with everyone today and report the results for FY21. We've gone a long way to continue to work towards being Australia's largest and most diversified allied health company, and these results show that. Some of the key highlights from the FY21 year is the underlying revenue growth. So underlying revenue growth of revenue was $140 million, up 42% on the prior period, and includes organic growth of 9.1% in there as well. Our underlying EBITDA, taking out the effects of AASB 16, so the leasing standard, is at $21.5 million, up 62% on the prior year. And our underlying EPS, so earnings per share of 11.13 cents, is up 52% on the prior year. So these results are a reflection of all the hard work that the teams have put in during that period of time. You know, the 9.1% organic growth is delivering a large chunk of this of the continued growth for the portfolio, but we also deployed the $62.3 million worth of capital during the year on acquisitions, with the largest being the Optical Co acquisition in there of $42 million. So we'll continue to target a minimum of $20 million of capital deployed each year on new allied health acquisitions. That's supported by the cash flow that the business is generating, as well as the finance facility we have in place with ANZ BOQ, and we've just recently brought in NAB. So when we brought in NAB, we increased our facility from 50 million to 70 million, and at reporting date, we were at 51 million drawn. So still 19 million of that finance facility to draw down on. And we've also declared, and as you'll see in the annual report, a 2.5 cent final dividend. So taking the full year dividend to 4.5 cents. So all that happens, and all that's come together because of some good, really good growth and some good operational highlights, which we've highlighted here on this slide. So organic growth again at 9.1%. Driven largely by the boxes on this screen as well. So, you know, we continue to develop and work on our industry-leading education programs for our teams. So that's from our graduate training program through to our clinical and business leadership program, and then through to our biannual conference as well. So we continue to develop those. We're working on our recruitment, retention and attraction strategy. So, you know, our people are core to what we do. So ensuring that we keep our people engaged with the Healthia story is very important. And we're doing that through our education. We've got our clinic retention program in place, which is where our clinicians can have ownership alongside of us through clinic class shares. And we continue to build on our workforce by recruiting new graduates each year, and we recruited 60 at the start of this year to help continue our organic growth. It's pleasing to see our clinician retention rates still sitting at 85%. But to verify that we're doing a good job in our team's eyes, we went and we conducted a survey with Best Practice Australia during the year. So we did this survey back in 2019, and we scored an engagement score of around 59%, so just outside of a culture of success and a culture of consolidation. So that's, to be in a culture of success, you need to score greater than 60%. And it's pleasing to see that across the group, our team scored us at 62%. So our teams are engaged. And we're sitting in that culture of success. It picked up a number of things they want us to work on, and it's given us areas to focus on over the next 12 to 18 months to continue to improve on that engagement and hopefully continue to improve on that staff retention rate as well. We've also worked on a number of operational efficiencies during that period. As mentioned before, the largest acquisition we made last year was the Optical Co, 41 optical stores, and iFrame distributor AED. We deployed $43 million of capital on that acquisition, and we've worked largely during the last 7 to 8 months to integrate that business into our systems. It's pleasing to note that we have done that. We've aligned our marketing and strategies, our customer retention, our people retention strategies, and we've overlaid our clinic retention program there as well. So, we've continued to build on the education programs that they were already doing, put a little bit more structure in place around those, and we've extended our clinic class share program across to the Optical Co as well. So now our optometrists can have co-ownership alongside of us. So that acquisition's going extremely well. And then we've also in there executed on the audiology part of the business that we said we would. So, as part of the optical acquisition, we noted that we wanted to co-locate all the audiology services inside of our optometry practices. And I can say that we've now got one open inside of our Kevin Paisley store in Geelong, which is also servicing Warrnambool as well as a satellite clinic as well. In there, during the year, we also recruited a chief marketing officer. So it's the first time we've had that position inside the company to help us with our marketing strategies and our clinic retention programs, and help us to work out how we can use this large amount of data that we have for our patients to be able to get them into other services. They're accessing physiotherapy now. There's no reason why they should be accessing podiatry or optical across the group. So I touched on the underlying performance before, revenue up 51.2%, underlying EBITDA up 62.3%, and our net profit after tax up 91%. One of the pleasing things in there that we haven't discussed on the first slide is just our underlying EBITDA margin. So it's gone from 14.3% up to 15.29%. So nearly a whole 1% improvement in margin. So that margin, like the rest of the rest of the performance, is largely driven by the organic growth that we're getting out of the business, but also the operational efficiencies that we're starting to get with some scale and the cost controls that we've put in place. Also, the introduction of TOC, or the Optical Co, has helped improve that margin as well, given that the optical business is a high margin business led by our AED vertically integrated strategy. Like all of Australians and all of Australian businesses, we're not immune to COVID and the impacts of lockdowns and COVID, government-imposed mandates around COVID. We are an essential service. We remain open and we operate. And we see our clinics really rebound quickly post-lockdowns. But with that said, we have had some impacts of COVID over the year. You can see there in the table, we had nearly 1,500 days affected by impacts of COVID in the last 6 months. So between January and June, we've seen about 1,500 days being impacted in our clinics because of COVID. The chart here, you can see the blue line is what our actual revenue was, and the grey line is how we've normalised the effects of COVID on the way through. So the largest effect being the impacts we saw through May and June. COVID's very unpredictable. We remain open. We are an essential services. We do have some impacts from them. The lockdowns are short term, and we rebound from the other side. So the directors are confident that the impacts of COVID are being managed well as we go forward. And it also helps, with the diversification of our portfolio. As you can see now, when we listed, 67% of our portfolio was in Queensland, and we only had a small portion outside of Queensland. That's starting to change as we continue to grow. We've, 53% of our portfolios in Queensland. We've now got 18% in Victoria and 16.5% in New South Wales and ACT. So we're continuing to expand our footprint, diversify our portfolio, and as we do that, the impacts are localised, and we're seeing less and less impact from COVID as we go along. The Optical Co was a step change acquisition for us during the year. It brought in a scalable, vertically integrated optical platform for us where we could grow optical and audiology. Since we settled that business on the 1st of December, we've made 3 additional optical acquisitions, and we've opened the audiology clinic inside Kevin Paisley in Geelong, as I mentioned before. But we also increased our addressable market from 6.5 billion to 9.8 billion, so a 51% increase. And we exited the year with less than 1.5% of that market share. So plenty of run rate for continued growth. And as you can see, we deployed the $62 million worth of capital on acquisitions last year. It was about a 5.3 times EBITDA multiple at the clinical level. That's a little bit higher than where we've been historically. We've typically averaged about 4 times, but the Optical Co, we paid a premium for that business. We paid $43 million for that business. And it's had an effect on the multiple over the year. But we also then deployed another, $20 odd million worth of capital during the year for additional acquisitions. We've also deployed since the end of, the start of this financial year, we've deployed $2.5 million worth of capital. We've acquired about $4 million worth of revenue and about $650,000 worth of EBITDA. We've told the market we'll continue to deploy $20 million minimum per year. Our pipeline for acquisitions is very healthy, and we're very confident that we'll be able to deploy at least that $20 million of capital in this current financial year. So just quickly on an outlook, where are we going? We're focused on that 4-tier strategy that we've been looking at since we listed in 2018. We know it's delivering for us. We're remaining patient focused and making sure that we're giving great outcomes for our teams. We're putting in place good marketing initiatives to retain our patients and to attract new patients to our business. We continue to work on our organic growth strategy. That's largely driven by our engagement of our teams because they are our revenue generators. So we've done the culture survey. We know where our teams want us to continue to improve, so we can continue to engage them. They'll drive our large components of our focus for them during the next 12 months. We'll continue to find accretive acquisitions. As I mentioned, we've already deployed $2.5 million this year. We've said we would deploy $20 million. We're comfortable that we can do that during the year. We've got headroom in our finance facility. The cash flow that the business is generating, plus our clinic class shares, will help us to easily deploy that $20 million to the pipeline over the next 12 months. And we'll continue to work on our vertically integrated businesses. As I mentioned before, we now have AED, which is giving us benefits on optical acquisitions from day one, and we're seeing GP margin improvement as soon as we push that across our business as well. And then the directors and management will continue to manage and monitor the impacts of COVID and lockdowns as we go forward. It's pleasing to hear that we're on a path to vaccination, and our state premiers are now talking about opening up once we get to certain rates. It's ever changing, it's unpredictable, as we all know. It's hard to crystal ball where we think things may land. But what we do know is our teams are getting really great at managing lockdowns. We've got processes and protocols in place that they follow when we lock down to make sure we're keeping our patients safe and our fellow team members safe. We see patient volumes come back a bit, but our patients still come and see us. And then we see it rebound quite quickly post-lockdowns as the pent-up demand comes through from our patient base. So in summary, it was a great year. We had some great growth driven by organic and acquisition activities, and we remain focused on continuing to deliver those into the future for our shareholders. Thank you.
Thanks for that very comprehensive presentation, Wes. Great result. We will now open the floor to Q&A. If anyone does have any questions, just open up your Q&A button on the left-hand side of your screen and enter them, and we'll just read them out as they come through. Wes, I've got a question from Carl. Carl asks, how does organic growth for eyes and ears compare to the other two divisions?
Yeah, look, we haven't held the businesses for a whole 12 months, so we haven't included it in there. We do have due diligence information, obviously, that we pulled through when we did the transactions. Look, healthy single-digit organic growth still, but look, we haven't reported it because it's not as accurate as the other information for our bodies and minds and our feet and ankle division.
Excellent. Wes, got a question from Bruce. Do you expect the EBITDA multiple for acquisitions to trend back towards historical 4x, or will it remain elevated at 5.3?
No, look, the 5.3 is largely affected by the 6.9 times we paid for the Optical Co. So look, our other acquisitions during the year were around that 4 times. So the single or small group practices, the 3.5 to 4.5 times is still the market. It's just, the Optical Co was a step change business, one that had an established support team that came with it, plus the vertically integrated strategy of AED. So, unless we're buying a big, large group, we expect, the single to, small multi-practice groups to still trend around that 3.5 to 4.5 times EBITDA multiple.
Thanks, Wes. Question from Sam. Can you detail a bit more about how the umbrella of brands in the group will be managed from marketing perspective? Are the marketing efforts going to be focused on local marketing with individual branded clinics, or clinics going to be merged into the single brand of Healthia to create industry and public brand recognition as a leading healthcare company? How is the risk of brand confusion going to be managed?
Yeah, look, they're local businesses. They service a local community. They had brand presence when we acquired them. So to change them into one brand is not the strategy we're after. Technology allows us to manage it easily from a marketing perspective. We've got centralized data. Everything falls into a data lake warehouse, whatever the techies want to call it. And you can easily manage multiple brands on your messaging to your patient database through that. So look, at the moment, we don't have a national strategy. Our chief marketing officer is working on some ideas how we can bring it all under one umbrella a little bit better. But look, nothing's been decided as yet. We're managing it very locally.
Thanks, Wes. Question from Richard. Can you give us an update on the US business?
Yeah, look, it's doing extremely well. It's the printer's at capacity over there, and we're having to outsource it a little bit at the moment. But COVID's really slowed that strategy down a little bit. We'd love to be able to get someone over there and really expand on that business, but it makes it hard. Our local partner is doing a great job, but our local partner is also running their own lab over there. So at the moment, we're putting through our workflow into their lab to prove that we can improve margins in an orthotic lab in the US by using our workflow. So, watch this space. We haven't given up on it. It's just COVID slowed things down a little bit.
Thanks, Wes. Looks like you've been very comprehensive because we've only got one more question. If anyone does have any, please enter them now. Question from Warren: which allied health disciplines are being most impacted by COVID lockdowns?
Yeah, look, they're all a little bit different. Optical is the one that gets impacted the most just because it's a routine service. You go once every 18 months, 12 months to get your eye test. You can put it off a little bit longer. The least impacted is physiotherapy. If you're injured and you're hurting, you're not going to put that service off. You're going to continue to go, you're going to continue to seek out your service. And physio's got a very high rebooking rate. So you come in for one condition and you're seeing nearly 8 times before that condition's fixed. So you might have started your service pre a lockdown and you're still going on it post a lockdown. So the spectrum's there. The least is physio, the most is optical, and podiatry sits in the middle somewhere.
Thanks, Wes. Got one here from Bruce. Can you provide a little more colour around the revenue and earnings across the 3 business lines?
Yeah, look, there is a segment note inside the annual report. I don't have it in front of me here, but if you look in the annual report that's just been released, there is an operating segment note in there. Keep in mind the eyes and ears division was only operational for 7 months because we acquired the business on the 1st of December. But there is that note on page, what page you got there, Chris? Page 42 of the annual report.
Thanks, Wes. Question from Kelvin. Can you give us a sense of the approximate pro forma EBITDA of acquired centres for FY21 for the period prior to HLA ownership?
I'd be giving guidance, and we're not in business of giving guidance at the moment. So look, I'd love to, but that would mean I'd be essentially giving some sort of market guidance, which the board's asked me not to do. Again, you can find, if you go to the acquisition note inside the annual report, part of the accounting standards asks you to annualise the effect of acquisition. So you may be able to pick up some of it from there.
Fantastic, Wes. All right, we've just got one last question and then I'll bring the session to an end. It's come through on email. Michael is asking, how do the margins from audiology compare to the other business divisions?
Look, it's early days. We've only just brought it in, but given that we're already paying the rent in the locations we're putting them in, it's selling a product. We expect it to be quite healthy, but look, early days, and I wouldn't want to comment on it just yet.
Fantastic, Wes. That's all we've got in terms of questions. So on behalf of all the attendees, thank you very much for your time today. Fantastic result. And we look forward to hearing from you again shortly.
Excellent. Thanks, everyone.